So we're going to go through this information that's been given to us and how the adjustments were made. So the first item that comes in the income statement, item number 1, is the sales revenue. The revenue you made from selling the goods. Okay, sales revenue is the first thing. In our information here, sales revenue is where is that? Sales revenue is here, 420,000. Okay, this is the sales revenue. It will be the first item. Mukuba Supplies sold goods and made 420,000. So you put it here. Oh, I forgot to mention, your income statement should have 3 columns. These columns don't have names. What you just must remember is this last column is for the grand totals. Okay, it is for the grand totals. Because format is also key when you're answering these questions. Okay, the second column, this is where it's from adjustments basically. Okay, you might get some totals in here, okay, but mostly this is for adjustments. Okay, where you're doing the adding, subtraction. All right, even in the grand totals there'll be some addition and subtraction, but most of the workings are done in this second column. This first column is also for adjustments, but the only adjustment you are going to see mostly is adjustments that have to deal with purchases. Okay, this first column, usually adjustments with purchases where you're going to see anything happening. Other than that, that's the only purpose. Okay, so remember, when you're making this, put 3 columns like this. Okay, once you start doing financial reporting, it's just 1 column. Okay, yes. So first things first, revenue 420,000. Okay, now usually revenue you put it on the 3rd column. The reason why I'm putting it in the 2nd column, because there's an adjustment that needs to be made to the revenue, and this is what we call return inwards. Now I believe you've done group discussions on this question. Colleagues, what is return inwards? Because remember, spoon feeding with me, you only be spoon fed in July. Before exams, that's why you'll be spoon fed. So colleagues, what is return inwards? Mr. Peter?
Yes, I think return inwards goods were cut off. Now then to try be color or maybe wrong something, and someone is
unfortunately you are breaking, but let me just, but thank you for your contribution, Sam. Okay, thank you. It's just unfortunate you are breaking. Return inwards, colleagues, this is when your customers bring back goods to you. Okay, it's a contra revenue account. Remember, a contra account reduces something. So a contra revenue account means it reduces your revenue. So you're going to subtract your return inwards. When you see me put a bracket like this, just know I'm subtracting. Okay, so you're going to say return inwards, according to our information here, return inwards 13,400. You subtract 420,000 minus 13,400. You get 406,600 kwacha. Any questions? In high school books, you're going to see this called as turnover. Other books, you might see this as net sales. Okay. If you want, you can just leave it blank, okay? Or you can put here turnover or net sales. Yes. Any questions before we go to the next part? Okay. The next section of the trading account is where we have to tabulate the cost of the goods sold. Colleagues, remember this: you cannot make a profit from goods that you have not sold. Okay, you cannot make any profit out of goods that you haven't sold. Okay, so that's why we're only interested in the cost of the goods that have been sold. Okay, I forgot to put this formula. Remember here, the formula here which we're working with is gross profit equals sales revenue minus cost of goods sold. Now with the cost of goods sold, the first thing you want to tabulate is the total cost of goods available for sale. Okay, you want to say, okay, this year, what is the worth of all the goods that I had in my shop? Okay, that's the total cost of the goods available for sale minus the closing inventory. Okay, once you get the total cost of all the goods that you had available, and you deduct the closing inventory, the goods that have remained, you're going to get the cost of the goods that have been sold. Okay, so that's the first thing you want to tabulate. You want to say, okay, what is my total cost of goods sold? Okay, so to get your total cost of goods sold, okay, you want to find out what is the total value of all the goods that I had in my company. You're going to start with your opening inventory. These are the goods that you begin with at the beginning of the year. Okay, so here we're focusing on the cost of the opening inventory. Okay, what is the value of the opening inventory? The value of the opening inventory is 11,600. Okay, so at the beginning of the year, Mukuba Supplies started the year with inventory worth 11,600. The next, during the year, want to find out what goods did Mukuba Supplies bring into their company. All right, so that's where we now say we bring in purchases. Okay, that year Mukuba Supplies bought goods worth 235,600. Okay, they started with goods worth 11,600. Then they purchased goods worth 235,600. Now, for these goods that they purchased, that was worth 235,600. Some goods were returned back to the supplier, returned outwards. When you return goods to your supplier, okay? So whenever you return your goods back to your supplier, what happens to your purchases cost? If you buy 3 phones worth 1,500 and you find, and each phone is 500 kwacha, and you find one phone is defective and you return it, What happens to that 1,500 kwacha which you originally paid? Does it remain the same? Does it increase or does it reduce?
Reduce.
It reduces. So that's what we're saying. Less return outwards. Contra expense account. Okay, it reduces the purchase expense. Then discount received, colleagues. Discount received, there are two ways you can deal with it. Okay, there are two ways you can deal with it. One way you can deal with it, the way I've shown it here, is remember whenever you receive a discount from your supplier, it means the expense, the purchases expense you incur is reducing, right? It's reducing. So you can also deduct your discount received here. Okay, when you purchased these goods worth 235,000, right, you are also given, apart from returning some, you're also given a discount. So that's why we're subtracting. The other way you can deal with a discount received is, since a discount received, it means you've saved money. So you can also treat it as a form of income, and you can add it to the gross profit after you find it. Okay, so there are two ways to deal with discount received. Okay, so for this video here, I'm showing we can deduct it from the purchases expense, because a discount given to you means you're paying less. That's why we're reducing. So we purchased goods worth 235,600. Then we returned goods worth 7,900. And on top of that, we were given a discount. Okay. Apart from returning goods worth 7,900, we're also given a discount of 1,240. So our purchases expense, 235,600 minus 7,900 minus 1,240, 226,460. Okay. So basically we purchased goods worth 226,460. Any questions before I move further?
Sammy, I have a question. Actually, I'm lost. On how did you come up with this 11,000?
It's given to us here.
Oh, it's given to us.
Yes, opening inventory 1st April. I forgot to mention here. Here. Initial purchases expense. Here.
Oh, so everything is given to the data.
Yes.
Now, just a matter of us applying it.
Yes.
Now, my other question. How do you know to say now this one closed, you need to start another year. Like the way you have closed for these revenue made from selling goods and return inwards. And this turnover, net sale. How did you know say now you have to close this one, start another one? How do you know? Say you now have to close this one, start another year.
By understanding the format of this financial statement, that's how you know where to stop and where to go next. Once you understand how this thing is working, you know, okay, here I've got this, what I need to get.
I think I need to understand that.
Yes. So let's go through the story of what's happening here so that you get an understanding. So here what we're trying to do is we want to find the total cost of all the goods available for sale. Okay? So that once we get that and we deduct closing inventory, we'll get the main objective, the cost of the goods that have been sold. Okay, madam?
Yeah.
With this formula here, okay, cost of goods sold, total cost of goods available for sale minus closing inventory. So first one, find out this year all the inventory that we had, how much was it worth? Okay, all the inventory that we had, how much was it worth? So you first
you add them.
No, there will even be some subtraction somewhere, but yeah, I'll show you where you add, madam.
All right.
Yeah. So this year we started our year with goods worth 11,600. That's our opening inventory. Then we purchased goods worth 235,600. Now there are some adjustments we need to do to this purchases expense because we returned some goods and we received a discount. So we can't just leave it as 235,600. Okay? So we returned goods worth 7,900. So it means this purchases expense has to reduce because when you returned the goods,
Subtract.
yes, you subtract. Then again, we also received a discount of 120 to 1,240. So again, our purchases expense has to reduce, right?
Yes.
Yeah. So now, once we've done our adjustments, the goods that we purchased for this year and brought into our shop, they are worth 226,460. Now remember, we want to find the total cost of all the goods available for sale. Alright, so we started this year with goods worth 11,600. Then we brought in goods worth 226,460. So when we add 11,600 plus 226,460, what do we get?
$38,060.
Yes. So think of this as the total value of all the goods that you had that year. So if you bought 1 million bags of cement for that whole year, and this is their worth. Any questions before now we get our cost of goods sold? And this is the part, colleagues, you always have to be careful, because a lot of times, even me, I used to make this mistake. Once you find your total, once you found your adjusted purchases value, you might forget to add this opening inventory, and you just go straight to deducting your closing inventory. So please remember, once you get your adjusted purchases value, add the inventory that's on top. Okay, because those are the goods you started with. So if you started with 50 goods and they're worth 11,600, and then you brought in a total of 200 goods that year worth 226,460, The 250 goods that you had that whole year, their total weight is 238,060 kwacha. So now, next, since there was no question about that, next now I want to find out, okay, now the goods that we sold, what was their cost? So that's why now we subtract our closing inventory, because at the end of the year we remained with goods worth 14,200 kwacha. Okay.
You subtracted what and what?
I'm subtracting the closing inventory from the total cost of goods available for sale.
Okay.
Think of it like this. I just want to put this on the side.
So the closing inventory is given there on the data is there.
Yes. So for example, if you had 200 goods worth 226,460 and you remain with 100 goods worth 14,200, you want to find the cost of the other 100 goods that you sold. Okay. Or maybe let me put it like this, because 100 and 200, I want you to really visualize this. Let's say you had 200 goods worth 226,460 for that year, and you remain with 50 goods. $200 goods worth 238.60, and you remain with 50 goods worth 14,200. You want to find, okay, what was the cost of the 150 goods that I sold? Okay. So we're going to say total cost of goods available for sale. So these 200 goods were worth 238,060 minus the value of the 50 goods that remained with 14,200. So this minus this, you get 223,860. This is telling us these 150 goods that you sold that year, okay, they costed 223,860. Any questions? That is the cost of the goods that have been sold.
So sir, a question. When you subtract the total cost of the goods available for sale minus the closing inventory, you put it on the column for ground total. So those are the only calculations that are supposed to be on the ground top. Subtracting, you close, you do the finalize, then the last answer you put it to the ground total.
I won't say 100% like that, because as you see, when we go in there, there'll be. But basically, yes, on average, yes. Okay? On average, yes, madam. Once you've got the totals of things that you're looking for, you bring them to the grand total section and do the final adjustments. Okay? So here, the totals we're looking for is the value of our net sales, after we remove the retaining ones, and the value of our cost of goods sold, so that we can get our gross profit. Okay, because remember this formula, madam, gross profit,
yes,
sale, So maybe the way you can put it is, so the sales revenue and cost of goods sold are the ones you'll find in the grand total. Then these ones in between, you won't see them in the grand total. Now colleagues, please remember, don't try to memorize this. I'll give you a lot of questions to practice. Okay? Just understand. Okay, where was I? Right, yes. So gross profit, net sales minus cost of goods sold, you get 182,740. Matching concept being applied here. Colleagues, do you remember the matching concept in accounts? What is the matching concept? It's part of your group discussion thing. So at least when you're discussing with your group members, you can say, oh yeah, so this matching concept, this is where we apply it. Who remembers the matching concept? Record revenue and expenses for the same periods. So here we're talking for the period of, I don't know when was the year end for this. July 2024. Why not 2024? 30th April. So from 1st April 2024 to 30th April 2025, we're recording all the revenue and expenses incurred in that time period. Okay. If any revenue or expense is not in that time period, do not include it. Okay. Yes. So for example, you can't have revenue for January and the expenses for December. If you're doing it on a monthly basis, that's the matching concept on a monthly basis. If you're doing it on a monthly basis, you can't have revenue for January and expenses for December, or vice versa. Just be revenue for January, expenses for January. Okay. And also the accruals concept is also being applied here. Where is the accruals concept being applied? Here in revenue. Remember the accrual concept, when record revenue even though you haven't been given money, also expenses even though you haven't paid out money. So this revenue here, this sales revenue, it's not only from cash sales, there can also be credit sales in there. Okay, so all this gross profit here, the company might not have it all because there's some cash that hasn't been collected. So remember those two concepts. Yes. So this is basically where the trading account ends. Okay.